Welcome. It's finally Friday. You're watching India Market Open. There could be some Friday cheer in Dalal street on back of a good setup globally. Hopefully that stays for the rest of the day or for the day.
Yeah, absolutely. Now, complete reason to cheer. It's a fun Friday and another silver medal for India. Neeraj Chopra, the javelin thrower, makes it to silver. He misses the gold just by a bit, but I mean, what a champion all the way. So something to celebrate going into Friday and hopefully a better medal. Look at the cues. We were telling you yesterday about how weekly jobs data would be crucial, and it's come in as expected. As a result, the entire mood has turned positive. So let's start with where the futures are. The futures also positive right now, but a strong rebound in the US as investors, quote unquote, buy the dip. An idea now that the kind of sell-off that we've seen in the US markets, is not something which will continue. It is transient. So you've seen everything in the green. The Nasdaq up 3%, the Dow up nearly 700 points, and of course the Dow futures still up in the green as well. So what is that data which has really worked? So the US weekly jobs data is much better than expected, and as a result, recession fears have faded. And we'll pull up those numbers for you as well. They've come in at 233,000. The weekly jobs numbers, and much lesser than expected. This is the number of people who don't have jobs, and that has really aided the mood. As a result, bond yields have also gone up. In fact, the 10-year treasury is closer to the 4% mark. That's not necessarily great news for India, but considering it's because recession fears are easing, that's always good news. So 3.97% there. As a result, crude has been buoyant as well, was up almost 1% overnight, and Brent is back at $79. The underlying issue of Middle East tensions and never knowing when things could escalate between Iran and Israel is always a concern at the back of the mind. But we've seen through the last 12 months at least, crude hitting a ceiling whenever it goes up and not really managing to cross 90 on the Brent. So $79 to the barrel at this point. Let's also look at how Asia is open. So Chinese data which came in was not as bad as expected. The consumer price numbers have come in. Their export data also was not as bad as expected. But in any case, Asian markets have followed global cues, followed US cues, opened up in the green. And let's pull up the implied open and you will see a spot of green there as well. So remember, we had a rough day yesterday, about 0.5% down on the Nifty, and you're looking like you're going to open about 250 points up. In fact, if you just pull up the fund flows from yesterday, you get a sense of continued FII selling, and that has been the pain point, isn't it? 2,627 crore rupees in sales. Domestic investors bought in, but not that much, 577 crores. And this comes on a day when you had, a hit through the day. Profit booking through the day. It didn't intensify except just in the last bit of trade when the Nifty closed over 1% down. But nevertheless, you have seen that profit booking trend continue. I mean, the big question really, Samina, is you're going to open gap up, you're going to open strong, but can that sustain?
That's the tough one, but from the look of it, given that it's Friday and the RBS policies behind us, the weekly expiry is also done now, there's a good chance the Nifty may actually hold on to some of its early morning gains. Quick recap on what happened yesterday. The market sold off very much in line with what the global equity markets were getting up to. So you had a weak handover from Wall Street and Asia that trickled down into Dalal Street. Our market saw a gap down, stayed lower, finally went home with a cut in overnight in trade. RBS hawkish stance and weak global cues led to yesterday's selling pressure. The Nifty is down 2.5% for the week so far, but a little bit of recovery is expected in today's day of trade. Bank Nifty was rather resilient, surprisingly, in yesterday's day of trade, and bellwether HDFC actually stuck its neck out and limited the losses on the index by gaining in trade yesterday. Well, Bank Nifty, despite outperformance to the index in trade yesterday, has actually managed to lose out 2.4% for the week. IT also did quite badly, and so did metals, because these are global-facing companies, and on back of global cues, those were the weakest spot in our trade as well. Well, PSU stocks have been on the sell side for most part of this week. Weak earnings yesterday led to further selling pressure on some of the names. But as we go into trade this morning, like Tamanna said, the handover across world markets is positive. Asia is looking pretty solid, and on back of that, implied Nifty is also indicating to a 250-point gap up in early minutes of trade. Well, what's going to be important? Let's take you through that. 24,400 has been this week's high, so that is going to be a very important level that the Nifty and the bulls will try to take out. If we do manage to sustain about levels of 24,400 on closing basis today, 24,700 could be in sight for the Nifty in the near term. On the downside, 23,900 and 24,000 have turned out to be very important in terms of near-term support for the index. So even on tough days, the Nifty has respected those levels. So that will act as key support on the downside, and on the upside, 24,400 becomes critical. If we do get a close about 24,700, then you know that the bulls are back with the bang, and then they will initiate long positions. Until then, of course, this market remains a sell on rise. Well, apart from that, it's going to be all about earnings. So stocks like Eicher Motors, Biocon, LIC, SAIL, Cochin Shipyard are counters that reported post-closing yesterday. So a reaction to that will be important in today's day of trade. Stocks and sectors that may lead the up move today is going to be IT and metals. For obvious reasons, they were the big losers yesterday. So they will be the big gainers today on back of a bounce that could be expected on global cues. Oil and gas stocks may also not do too badly. Oil India reported numbers that were good, and beyond that, crude is trading under pressure. So it's not sort of giving way. There's not too much upside gains coming in on crude, and that is always good for stocks like BPCL, HPCL, and IOC. Bank Nifty will be interesting to see how this one plays out in today's day of trade. After yesterday's outperformance, maybe the resilience on Bank Nifty may continue to show up. The leadership, though, may potentially come in from PSU banks as opposed to private sector, which took the lead in trade yesterday. So all in all, Tamanna, we are going to mirror what global markets are doing. Yeah. Sectorally as well, IT, metal. So stocks that lost the most will gain the most today. And also because if we're gaining on global cues, those are going to be sectors that may lead the way up today. And oil and gas may do okay as well, but it's going to be about earnings once again.
Absolutely. And some of that earnings excitement may spill over from what we saw yesterday. A Bharat Forge, for instance. Excellent numbers, very strong brokerage notes this morning. And, overall, a good up move, which we saw in the last part of trade. So you saw that 3% up. You could see more of that come in today. I would be keen to see if a Tata Motors continues its speed for a third session in a row. It was up yesterday. Will you see autos then now losing out or not? That's one thing to definitely watch. But yes, it is about the numbers. So let's start with what was reported after market hours yesterday and what should be on your radar. Let's begin with LIC. Now, LIC's net premium income was up. Overall, I would say a decent set of numbers. Good numbers for the company this quarter. Net premium income was up 16%. Net profit was up 9%. APE is an important metric to watch for this space. It's annualized premium equivalent. It grew 11% year on year to 21,180 crore. Value of new business, VNB, is also another very important metric. It grew 23.7%. VNB margins also increased to 13.9% from 13.7%. The net premium income was also up 16%. Net profit was up 9%. So how should you break down the set of numbers and how should you look at it? Well, for one, the annualized premium equivalent, APE, and the value of new business growth was strong on both fronts, so 21% and 24%, as we told you. The margins, which have come in, are largely in line at about 0.3%, which would say that LIC is pretty much a thumbs up this quarter and has done fairly well. Soba, on the other hand, I would say it's a mixed play. Now, the realty space has not had a very good quarter overall, and it tends to improve when you have festive season or times when people want to take deliveries of their homes, etc. But revenues were down about 30%, close to 30% for Soba at 640 crores. Their EBITDA was down 15.5% as well. So operating profits have seen a hit. Margins have improved though, and that's a big one. Net profits though are down 50%. Now, there's a miss, obviously, on the revenues and the profit front. But revenue from bookings, pre-sales value becomes a very, very important metric for the real estate space. That is up 28%. Collections were also up 14% at 1,546 crore rupees, which is a positive. So I would say a mixed kind of a number for Sobha coming in. Biocon, on the other hand, is a tough quarter. Tough quarter for the pharmaceutical company. Revenues have pretty much been flat. No big movement there, up about 0.3%. Their EBITDA, the operating profits, are down 13.3%. Margins have also dipped at 20.9%, from 20.9 to 18 odd percent. You'll see the net profit number going up at 861 crores versus 149 crores. But please keep in mind that includes a portion of other income at 1,135 crores versus 94 crores in the same quarter last year. This has been a big quarter for the company news-wise in terms of their tie-up with Eris Life Sciences. What has been the impact on their numbers is something that we'll be speaking to the company later in the day on NDTV Profit. But suffice to say, could see a bit of pain just as the markets open.
Yeah, add to your list, Tamanna, the whole lot of companies that have reported, big ones and even more smaller ones today. But just to top up on Tamanna's list, one standout once again this quarter is ABB. It's reported strong earnings for the last 3 quarters, and this one by far is the best. Good numbers. Revenue was up 12.8%, so quarter was strong, coming in at 2,831 crores. EBITDA was up a significant 56% at 542 crores versus 348 crores reported in the same quarter last year. Margins have significantly expanded by 527 basis points, coming in at 19.6 versus 13.8. So big time margin expansion, record in terms of revenue and EBITDA, and net profit has also seen a big jump of 50% at 443 crores. Now remember, it's not just ABB, the whole sector has had a phenomenal show. The likes of Siemens also will be no different when they report earnings, but it's also been 3 strong quarters, so sustainable growth very evident with this one. Well, what stood out for ABB for us, the growth was driven by very healthy execution, so operationally as well, the company is doing quite well across segments like motion, electrification and automation. Margins, gross margins have also improved significantly. So net margins were higher by 520 basis points, but operationally, when you look at gross margins, they've expanded even more by about 631 basis points. This was aided by better revenue mix, positive pricing, and a stable input cost setup. Order inflows have grown 12.8%. The domestic book looks very healthy, and their order backlog stands at a whopping 9,517 crores. We will understand from the management the execution timeline for this, but very, very healthy in terms of order book as well. Well, the other one that's should see a positive reaction this morning is Cochin Shipyard. But a couple of caveats on this one. Year on year, the numbers look extremely good. So revenues were up 62%, EBITDA was up 125%, coming in at 177 crores versus 79. Margins have improved significantly to 23% versus 16.6, and net profits are also up 76%. So Y on Y, Cochin Shipyard is a clear beat to Bloomberg estimates and what brokerages were expecting. But if you look at the numbers from a quarter-on-quarter perspective, they're actually quite weak. So they've seen a decline in revenue by nearly 50%. Profits were also down 40%. Couple of factors that stood out: the shipbuilding revenue and ship repair is largely an equal split. The cost of raw materials, though, is a problem for Cochin Shipyard. That has gone up significantly. In fact, it's doubled to 316 crores versus 166 that was seen in the same quarter last year. The stock, unfortunately, has been on the sell side. It's down 14% in the last 5 days, 19% in the last 1 month. Today, though, could be a day of recovery on back of those earnings and a positive market sentiment. So Cochin Shipyard could see a little bit of recovery on back of those earnings and the broader markets giving it the much needed support. Well, along with that, another one that I want to highlight is Eicher Motors. Record quarter in terms of revenues, EBITDA and profitability. They've managed to do quite well. Revenue is up 11%, 11%. EBITDA was up 14%. Margins have also improved to 26.5 versus 25.6. So there has been an improvement in margins. May not be significant, but nevertheless worth mentioning that there's a clear improvement on the margin profile as well. Net profits were up 20%. Couple of things that stood out. They've seen a good improvement. The international business is doing well. Domestic business has also grown significantly. The demand side currently sees commuter segments seeing a good sort of growth. So all in all, good earnings from Eicher Motors, very good earnings from ABB, and Cochin Shipyard as well. Good earnings, I would say, year on year, Tamanna.
Yeah, absolutely. So the next pack I've picked, Samina, are companies which are public sector companies and have run up massively. So
that would be all of them.
That would be all of them, but three of them specific. Let's start. So Ircon, Concor, and Oil India, because these are companies which are investor favorites. So have they really delivered? It would be interesting to see. Ircon, I would say, pretty much has, not bad at all. Revenues are down 17.3%. Their operating profit is down just about 2%. Margins, though, have improved. In fact, some of their best ever margin levels at 10.9%, which will be seen as a positive. Net profit is also up about 20%, 19.8%. The share of orders won on competitive bidding basis is about 51% of the total order book. That would be seen as a positive. And the total order book is about a little over 26,000 crore rupees. Now, this set of companies also, quarter on quarter, you have to see it from the point of view that their revenues don't come in consistently, so could be lumpy in that sense. Same, likewise for a Concor. Concor's revenue is up 9%, EBITDA is up 11%. Margins are also up in the positive, so they've gone from a 20.6% margin to a 20.9% margin, and net profit is up 7%. So good quarter definitely for Concor, a good quarter for Ircon, and I would say pretty much a good quarter for Oil India, despite a drop in revenues and EBITDA. That's because their realizations were lower. That's where they've been hit. EBITDA margins, though, are up. Look at the margins from 35.7% to 38.7%. So a weak quarter overall, but this was in line with expectations. Numbers have beaten the estimates of how weak it would be by a good amount, which is why I'm saying, though you're seeing some of the key metrics down in the red, it would be seen as a fairly decent quarter for Oil India. So a whole host of smaller companies as well, Samina, that have reported.
Yeah, and I'll just take you through a few ones. I'll start with the bad one, actually. Birla Corp, very, very weak earnings there. Their net profits are down 45%. To about 32 crores, revenues down 9%, EBITDA is down 135%. So it's been a tough quarter, on Birla Corp. Margins have also depreciated to about 11.8 versus 12.4. It's gone into the earnings with a weak trading day. Yesterday was down 2.5%. Today should be no different. It should be on the sell side of a number of traders as we see it. JB Chemicals, I don't know if you mentioned that one, but no, JB Pharma, pardon me. No. Quick check on JB Pharma. Very good set of earnings. We'll talk to the management later on the show, but they've hit the 1,000 crore milestone in terms of revenue. So very significant in terms of what they've done with that revenue number. Revenues were up 12%. EBITDA is up 42.7% at 280 crores. Margins have also improved nearly 2%, coming at 27.9, which is about 28%. Versus 26% that was seen in the same quarter last year. Net profits were up and the domestic business is doing phenomenal. It was under some pressure in the recent past, but now, of course, seeing a significant growth. 22% growth in terms of their domestic business is what we've seen. Another quick one is HPL Power Systems. Revenues were up 11%, EBITDA is up 42%. Margins have expanded significantly for HPL Power Systems and net profits were up 54%. So strong earnings from HPL, strong ones from JB Pharma, but Birla Corp a huge disappointment.
I think for last quarter as well. So they've had a couple of rough quarters on Birla Corp as well. But I'm now going to talk about some IPOs. So focus on IPOs today. 2 of their subscriptions close. Ola gets listed. So, a lot of new listings and the IPO primary market space in focus. Let's talk about Unicom Commerce e-Solutions first. And, this is a good gauge of how important the promoter pedigree becomes on how investors view a company. So the promoters of this company are the Snapdeal founders, Kunal Bahl and Rohit Bansal. This is a software solutions company. It specializes in web-based software for e-commerce clients and provides SaaS solutions, that's software as a service. Their key clients include Mamaearth, Urban Company, Lenskart, etc. Look at their subscription numbers, astonishing. I mean, as per the size of the IPO, but even taking that into consideration, 168 times subscribed overall. Retail subscription is 131 times. The NII subscription is 252 times. And QIB, that's qualified institutional buyers, have subscribed 138 times. So interesting to watch how this IPO finally does when it lists. Brainbees is the other one. First Cry is the brand that everyone knows them by. And it's an e-commerce retailer which focuses on baby products. Their IPO has done fairly decently as well. So total is about 4 times. QIPs have subscribed 5.86 times, non-institutional 2.51 times, and retail book is about 1.35 times. So it's a well-known brand, but this is the year of the IPOs, isn't it, Samina? With so many listings.
It is, and that's where all the household money is going, right? We had that conversation yesterday. So yeah, while this is really where all the money is coming in. Just one quick one, Tamanna. I know we've finished earnings, but I'll just add 2 more earnings because they will see some reaction in trade today. Bharat Rasayan, small company but very strong numbers. They've come out with their revenue growth of 18%, which looks okay on the face of it. The stock on a bad day has gone home with gains of 2%. Their profits have been exceptional, a 500% jump coming in at 43 crores versus 7. Now, there is a good chance there could be an exceptional item on the company, but definitely keep this one on your radar this morning. Could see a big move in trade. Timken and VA Tech Wabag have also posted good earnings. We will, of course, review those for you over the course of the next hour as we gear you up for trade this morning. Also, on yesterday's update, we talked about Protean eGov Technologies, which was expecting a big block. What we do know is Standard Chartered has come and exited their entire shareholding in Protean. This was on expected lines. We didn't know who the seller was, but clearly that's the deal. 3% of their last bit of stake in Protean has been exited at 1799 rupees a piece. So we talked about this yesterday, Tamanna, so just thought a quick update would be useful.
Yeah, absolutely. Now, you have a fantastic day ahead on NDTV Profit, some great interviews coming in. We will hear from LIC's Siddharth Mohanty ahead on the show and on the day. He's the CEO and MD of LIC. They've had a pretty decent quarter. We'll hear from Bhavesh Agarwal of Ola after their listing. So, ahead of the day, and everyone's very keen to watch how that IPO actually does. So, a whole host of voices on the channel today. Do remember to stay tuned. But India, it's interesting commentary coming in from Mark Mobius, who spoke with us yesterday. He says India is the best bet among China, Brazil, and Korea. He was in a conversation with NDTV Profit. He also spoke about volatility that could arise from the US elections. Listen in.
The RBI has done a very good job in regulating the money supply, regulating the exchange rate, and generally looking at the total economy in a very wise way. You must remember, one of the big problems in America is money supply, because during the COVID crisis, the Fed increased money supply by 20, 30, 40%, depending on which month you were talking about. And then they made a big decline in the money supply. And money supply is what really drives market, you must remember. Now, in the case of India, the RBI was not so extreme. During the COVID crisis, they did increase money supply, but not as much as in the US. And therefore, the downturn, the decrease in money supply was not as dramatic. So you have 2 situations, one very extreme in the US and one not so extreme in India. And that says a lot. And of course, if you look at the situation now, money supply growth in America is down to single digits. And a lot of the money that came in during COVID has been dried out. It's been used. That's one of the reasons why the market is weak. That's not the case so much in India.
Right. Okay. So the other big global factor that is playing out or could play out maybe in the next 1 month or whenever the Fed cuts rate? Assuming the Fed is going to cut rate from September to say till about January, how will money move after the Fed cuts rates by say 25, 50, 75 basis points over a period of 3 to 6 months? Will money move out of emerging markets? How will this play out, and how will you see money shifting to different assets apart from equities?
Well, a rate cut would naturally move money from fixed income into equities under normal circumstances. However, as I mentioned, the U.S. money supply is not growing at a high rate, and therefore there will not be a lot of money going into equities as a result of that. The equity market will do fine, but it will not be doing as well as it been doing in the past. Now, here's where the political situation comes into play. If the Republicans come into power in America, they will cut taxes. This will have a big impact on the markets. There'll be a surge in investment. In addition, the Republicans will increase production of oil and gas, which will mean a reduction in the price of oil and a reduction in the inflation rate in America, which will be very positive with the economy. On the other hand, if the Democrats come in, it'll be the opposite. You'll have increases in taxes, and you'll have a much more a stronger government spending program, which will generally not be good for the economy. So these are two different situations. That's the reason why the market in America is so uncertain, because nobody knows how this will pan out.
So we were talking about, you were talking about chemicals, and therefore pharma. How about FMCG companies? Consumption?
Of course, with the growing per capita incomes in India, consumption is going to increase, and people's willingness to spend more on consumer goods is going to increase. So the consumer goods area is going to be very good going forward.
Right. One last question. This is about how will you look at India in comparison to China? Do you still think that India is, seen as being overvalued, and it's shot up a lot? We have crossed the 25,000 mark on the Nifty. But when it comes to comparative valuation between China and India, would you still prefer India, or would you hunt for bargains, valuations in China?
Well, you must remember, China is gone X growth, let's say. 10 years ago, China was growing at 10%. Now, there's no way they can grow at that rate simply because the economy is too large. It's like the American economy. A growth rate of 3% in America is terrific. And that's the same thing with China. So going forward, you cannot expect high growth. However, and of course, by the way, that's reflected in the valuations. So the price earnings ratios of the Chinese stocks will be lower than that of the Indian stocks, because India is growing at 8%. Therefore, high price earnings ratios is justified in India because the E of the price earnings, the PE, the E is growing at a faster rate. So looking at these two countries, yes, there will be opportunities in China, particularly now the market is down and we're looking at some of the Chinese companies. But at the end of the day, growth is where it's at in India, and that's where we want to be.
Right. How about other emerging markets? If we leave China out, are there other emerging markets which are competing with India for funds?
Very difficult for other markets to compete with India because the other markets like Brazil, it's a big market, but difficult to find good value. Then you have Indonesia, again, not easy to find good value, but there's some opportunity there. Generally speaking, in Asia, Taiwan is very attractive. Korea is attractive, but again, Korea has become a very developed economy, so the growth rate is not going to be very high. So there'll be spots in different parts of Asia that will be interesting. but nothing will equal India, I believe.
Welcome back. This is India Market Open. We are looking at the futures and options space and how things are faring here. In fact, yesterday was another mixed day of trade. Weakness for the Nifty, but a little bit of strength for the Bank Nifty. And not too much change in terms of your August futures. So let's take a look at how things are faring there. At least as far as the Nifty futures are concerned, the Nifty came off by around 0.7%. But, well, the good news is that we held on to 24,000. Very little change, a little bit of unwinding coming in as far as the open interest is concerned. The Bank Nifty, on the other hand, was a relative outperformer, considering it closed marginally in the green. Very little change in OI there. But as we move into a new week, let's take a look at the range that we are working with based on open interest. We do have a substantial amount of writing around the 24,500 call, which will perhaps act as a little bit of a near-term resistance on the higher end, and naturally lower end we are keeping an eye on that psychological 24,000 mark, which also tends to have the most amount of open interest when it comes to the puts. But moving on to stocks, we have plenty of traction as far as longs are concerned in Alchem Laboratories, Lupin and MRF. And among stocks which are seeing unwinding, we do have a lot of long unwinding. In fact, for Apollo Tyres, Bajaj Auto, NTPC, Cummins, as well as Chambal Fertilizers. But let's take a look at what our experts are making of these markets. Well, we have Milan Vaishnav of Gemstone Equity Research, who's joining us on the show. Milan, good morning. Thank you so much for joining in. Your view on the benchmarks right now, and what kind of an option structure are you deploying here?
Hi, Agam. Good morning. My view on Nifty is quite range-bound because there are certain specific points that I am noticing. If we take a look at the derivative data, if we take a look at, if we took a look at the 1st August and 8th August expiry, what was observed that regardless of the volatility or the downside spikes that we saw, 24,000 continued to show a steadfast accumulation of the maximum call OI. Now, that being said, the only thing we have noticed is that in this week, the maximum, I was talking about the maximum put OI at 24,000. Now, moving on from there, what I'm seeing is that the maximum call OI, which was earlier concentrated at around 24,800 and 25,000, has come down to 24,500 levels. Now, going further into this, I also observed that beyond 24,500, there is very negligible writing of puts. Below 24,000, there is very negligible or near absence of writing of calls. So that being said, I expect that the markets will now, for at least immediate short term, may stay very, very range bound between 24,500 and 24,000 on the lower side. One thing is certain, that even if we see a good opening today, we are not likely to see any trending up move so long as we rule below 24,500.
Okay, so based on that, you are going short on a strangle?
Yes, I will once again go with a strangle. I'll be selling 14th August expiry 24,500 call, and I will be selling 14th August expiry 23,900 put. I'm looking at a maximum yield potential of around 6%. We collect 168 rupees of total premium. And as a part of risk management, we would exit this call if Nifty ends up violating 23,900 or if it moves past 24,500 levels.
All right. Milan, the other stock on your radar is from the Tata Group company. Can you take us through that one?
Yes, I'm looking at taking a bull call spread on Tata Steel. Dollar index per se is little bit weakish in nature, and by and large it plays out in favor of the commodity and the metal stocks. Tata Steel has tested its 200 DMA twice. It is likely to rebound from those levels. So I'm initiating a bull call spread there by buying 150 call and selling 160 call. We pay a net premium of around 3.55 rupees, and this translates into maximum profit potential of around 35,000 rupees. Maximum loss that we can ever suffer here would be 19,000 rupees. However, as a protective stop and to keep losses still limited, we can keep a protective stop at 142, and we will book profits in this call if Tata Steel moves past 160 level.
Okay, Milan, we'll leave it at that. Thank you so much for joining us and taking us through your views on the markets, and of course giving us those two option structures to work with in these times. Well, with that, it's back to you all.
Thank you for that, Agam. That's the market setup and the F&O picture and trading strategies by Mila Vaishnav on the index. Well, a quick check on the implied Nifty. It's indicating to a pretty solid start this morning. Remember, 24,400 is the current week's high, so that's going to be important in today's day of trade as well. That, of course, if taken out, could see the bulls taking the Nifty all the way to levels of 24,700 as long as the global setup continues to remain calm. This week has been about earnings, and so is today. Another strong set of earnings coming in from the stable of ABB. They've had 3 good quarters, and this one is no different. Anushi is standing by with more on that. Anushi, it seems like there's no stopping this giant.
Absolutely, Samina. It does seem like that. Now, if you look, it's not just this quarter that is a complete standout. It's been a consistent trend for ABB now. Now, if you have to look at this quarter, that is the quarter 2 of calendar year, which they follow, which is Jan to December period. If you have to look at the revenue growth over here, a 12% or almost a 13% of a revenue growth at 2,800 crores. Well, it's the EBITDA and the margins which clearly stand out with the increasing product mix to the higher margin portfolio. Now, EBITDA has seen about a 55.7% growth, while EBITDA margins have inched upwards to 19.2% as compared to 13.9% last year. Net profit as a result of this has seen about a 50% growth. Now, why are we looking at these margins increasing? Now, even if you look at the raw materials cost, now they were down about 4.7% in this quarter. And if we take the whole operating expenses in general, the total stands at about 80.8% of the revenue mix, which has gone down as compared to 86.1% last year. Now, in other key highlights also, the total orders were down about 4.8% at 3,400 crore, but the order backlog remained on the stronger side at 9,500 crore as as compared to 7,727 crore last year. So again, in the revenue growth side also, if you have to look at robotics and motion segment revenue, continued on the stronger path with about a 12% growth over here. Electrification segment saw about a 12% growth, but it's the industrial automation which stand out with 24% of a growth here. So this is the overall picture that we are building up in ABB. Strong set of results over here, and we look forward to how the markets react to this one.
All right. Thank you for that, Anushi. ABB, good set of numbers. Quite a few companies with decent numbers today, and expect to see reactions as per the numbers. That's the trend we've been seeing for the last couple of days on the street. Kush has joined us now. Kush Bora, founder, kushbora.com. Remember, you can watch him exclusively only on NDTV Profit. Very good morning to you, Kush. The implied open definitely telling us we're going to have a strong morning. In fact, let's pull up the implied open again for just a second. We're going to have a strong start to the day. The question is, are we going to see some profit booking coming in? Is the Nifty able to hold decisively now above the 24,000 levels?
Hi, morning, Tamanna. Actually, just a quick word. I don't usually regret things, but now just for a second, maybe I should have taken that long position after all, while closing that, the one that we spoke of.
We spoke about it yesterday, yeah.
If I were a trading man, I would go long on the indices. And wow, what an opening we're expecting this morning. But the view on a serious note remains the same. That yes, the indices had actually shown a lot of grit in terms of maintaining the lows that they had made on Monday, even Tuesday. That was actually a silver lining. But I was listening to a gentleman on the derivative show just a while ago, and my views also remain fairly similar. That the call writing that we are seeing at the moment, in Nifty, in Bank Nifty, might perhaps cap the limit on the upside. That is not to say that we may not go to those levels or even past those. But from a technical and an options data standpoint, the upside at the moment seems limited. So, for example, Nifty hovering under the 24,500 mark, which is the 20-day moving average. Bank Nifty has the resistance around 51,000, 51,500, which is the 50-day and the 20-day moving average respectively. So what I would do is, if I did actually, or someone did actually take that long position yesterday, I would take money off the table, live to fight another day, sort of an idea. We don't know. The markets are very volatile. You may perhaps get another entry point. So at the moment, if I did have a long position, I would take money off the table in Nifty and Bank Nifty both, and see how the setup pans out on Monday.
Pankaj Pandey also with us, Head Research, ICICI Direct. Pankaj, good morning and great to have you on the show. Now, let's just start with an overview on the markets, because we've had such a seesaw kind of a week, and we're looking like we may, have a good Friday in the opening. Can't really say what's going to happen by the end of the week. What are the sectors that you see recovering today? Is it the ones that got hammered the most yesterday, IT and metals?
So hi, good morning, Tamanna. I think overall sense of our market is that, so while we have seen corrections of nearly 4-5%, but these are typical corrections which you get multiple times in a year. And structurally, I think the domestic macros remain intact. So we have a very constructive view on the market. We have a Nifty target of 27,500 for the next 1 year. So we continue to remain bullish on the market, because 1 quarter down the line, we'll be introducing FY27 numbers also. And so largely from that perspective, we are constructive on the market. Now, coming to sectors, I think the global volatility is here to stay for some period of time, given the fact that the elections are coming up. See, 2 sectors get impacted the maximum, which is your IT and the BFSI. IT because of the tech spending volatility or not having enough clarity there. And BFSI largely because the BFSI bears the maximum brunt of FI selling. So I think these 2 sectors probably could remain sluggish. On top of it, metal, I think, continues to face its challenges, given the fact that the dumping from the China is still going on. The realizations are quite soft, even when you look at in this ongoing quarter as well. So I think these 3 sectors really do not, or I would not expect them to sort of outperform. I think rest of the domestic-oriented sectors, we are going to see more of a stock-specific move. So those look okay to us or good to us.
Right, that's the word coming in on IT and metals. Kush, as we're gearing up for trade this morning, there's going to be so much to pick from. But what are your top 2 to 3 stock trading ideas?
Hi, Samina. Sure. We discussed a lot of updates yesterday on Ipca Labs, Strides Pharma. I'll give one more update that I would have missed yesterday. That's on UPL. There's been a fair bit of volatility, but I think, the first target of 555 that we had discussed, I think just 2, maybe 3 sessions ago, has been achieved. I'm quite bullish on this one. 570, 575 was the next target. If anyone's got this position, they should continue holding on. Also, I'm rather bullish in a positional sense also. There's a congestion at 580. If that is taken out, I think the stock will see rapid momentum. And anyway, there's a lot of catching up to do, with the other, chemical stocks for this one. So positionally also this could, take off after this 580 congestion zone is taken out. That said, today's stocks, two of them, one from the futures, one from the cash segment. Aurobindo Pharma, it's been doing phenomenally well. Yesterday, day before, also the stock actually closed, higher. The volumes have also been higher, above the monthly averages. So, this one could continue its up move. 1499, 1515 are the targets. 1460 is where you place your stop loss. From the cash segment, SJS Enterprises, this stock has had a gap up and a seller move just about 4 or 5 sessions ago. But what's heartening to see is that it's holding on and building on to that move. So from a near-term perspective, 999 and 1020 are the two targets to look at. 955 is where you place your stop loss. So Aurobindo Pharma and SGS Enterprises.
S Enterprise and Aurobindo Pharma are two trading calls coming from Kush. The day will belong to lots of earnings as lots and lots of companies have reported between yesterday's close and today's opening session. Mahima is standing by with more counters to track this morning. Mahima, over to you. What else do we have on the radar?
Right, Samina. So I'll start with JB Pharma, where numbers did have a mixed forecast. Well, in terms of net profit, they did beat estimates. However, revenue and EBITDA did not beat the estimates. Net profit was up around 25%. Key highlights in terms of domestic formulations, the business grew by 22%. The revenue was slightly impacted by the CDMO business, and overall margins did rise on account of optimization in overhead, finance cost, as well as marketing expenses. Next in line is Timken India, where again a mixed quarter. In terms of net profit, it grew around 6.7%. Margins have significantly improved from 18.9 to 22.9. Some key highlights: margins improved on account of softening of raw material prices, and overall Timken Singapore, which is the promoter of the company, sold around 4.3 crore shares in Q1 FY25, and now promoters hold around 51.05% share. Next, SAIL also came out with its Q1 FY25 earnings, where net profit was down around 62%, and of course this was on account of an exceptional loss of 312 crores, and this exceptional loss was on account of allowances payable to executive employees. Moreover, the margins improved on account of cost of raw materials going down by 10%. Next, LIC, where net premium income was up 16%, net profit was up around 9%, annualized premium was equivalent, grew around 11% YOY, and value of new business advanced to 23.6%. The VNB margins also advanced to 13.9% from the 13.7% mark. They have also commented on the Bangladesh business. They've said that they've partially resumed operations in Bangladesh. However, the situation in Bangladesh may continue to hamper their overall operations, is what the management has said. And lastly, Biocon, where the revenue was up hardly 0.3%, EBITDA was down 13%. Margins have taken a hit from 20.9% to 18.1%, and net profit of 861 versus 149. So net profit has had a significant jump, but this was on account of other income of 1135 crores. So these are some of the earnings that came out post-market yesterday that will be on the watch out for trade today.
Right, that is going to be a busy morning with lots and lots of companies that have reported earnings. Well, you've also got quite a few big companies. In fact, Pankaj, I'll come to you with this one. ABB reported another very strong quarter of earnings. In fact, it's not just ABB. Even the likes of Siemens has done well recently. Suzlon, we've seen the kind of performance, spectacular earnings. Of course, now it looks like a rather expensive counter to discuss. BHEL too. What are you making of ABB? Are you constructive on this one? 3 good quarters, the fourth being as good. If I've got to take a cue from this, the rest of the year should continue to remain solid.
Absolutely. I think this quarter has turned out to be a record quarter for ABB. And I think given the growth in backlog, what we have seen, and the capex environment, our sense is that a company is going to post a good set of numbers for the next 3 to 5 years. I think the only challenge with some of these MNC capital goods companies is the valuation. So while one can hold the stock, but incremental buying, I think should happen only when there is some weakness. Sadly, we don't see much of a weakness.
Okay, so ABB definitely looking interesting. I don't know, Pankaj, if you have a view on some of the other big names this morning which might respond to results. How did you like a Cochin Shipyard? How did you like an Aisha? Aisha definitely in focus.
So Cochin Shipyard, overall, when you look at most of these defense PSUs, valuation side, they are definitely higher. But if you sort of exclude the valuation, I think for Cochin Shipyard, the numbers were quite strong. I think we have seen pretty good margins, especially on the shipbuilding side, ship repair side. And I think probably they might have executed some shorter term orders. But our sense is that this company looks good from the perspective that there could be some decisioning on the third aircraft carrier, and this company could be a strong contender for that. And I think new facilities are also sort of coming up. So one has to be constructive on or we are constructive on the stock. I think we would want some more weakness to sort of happen. But in general, the numbers came out to be good. And I think management commentary is also fine in terms of both ship repair margins in the range of 22-23% odd and overall EBITDA margins of 17 to 19 odd %.
Right. Okay, so Kush, just talking a bit about some of these companies and some of the PSUs actually. PSUs have been very volatile all through this week, one day up, one day down kind of a situation. And you have some numbers coming out today as well. Concor, for example, in focus, Oil India, definitely one of them. Anything here on the charts that you think looks constructive?
So, Tamanna, we've been tracking this for some time now, and honestly, there isn't really, a trade panning out on these. We've seen a downward slide, but that doesn't seem to stem. Of course, you'll have these days and a couple of sessions of rebound, but other than that, I think a lot of them have been under pressure and not really showing signs of bottoming out just yet, even on the momentum indicators, or if you see, just by the plain, setups. If you see in terms of the supports and averages following through. Even Concor, was the darling of the markets for some time, but has given way. Anything, if at all anything, then it's the oil and gas space. It's got some momentum going for it. So Oil India is perhaps one stock that you'd want to put on your radar. It's again at the 20-day moving average support. But other than that, I don't think there is too much in these names that we just discussed that really warranted trade at the moment.
That's interesting. So not too much in these names that warrants a trade. Well, a few more counters that will be reacting from the broader markets. Now, of course, these aren't big companies, but definitely worth talking about. Pankaj, I'll start with you on the fundamental view of a few names that reported yesterday. So you had JB Pharma. What did you make of those numbers? Birla Corp, it's again been a tight quarter for them. Bharat Forge, small company, but such a massive jump in terms of profitability. Do you track any of these smaller ones? And I'll add SAIL to the list, even though it's not small.
So on the pharma names, we don't track companies what you mentioned. So for example, but when we look at yesterday's number, I think Alembic came out with good set of numbers. So while the US and the India business continues to sort of do very well, I think the company has been maintaining good gross margins of 70 to 75%. It is not really percolating into EBITDA margins because the company is incurring a higher capex on the new plant and plus the R&D expenses. Our sense is that with key geographies like US and India doing well, one can be constructive on the stock. Obviously, we'll come out with a detailed note and then I can talk of number in terms of target prices. But we like the numbers. I think Biocon sort of continues to sort of disappoint because, all three segments, so except for the services part, which is Syngene, which is looking good from a future perspective because biotech funding is largely getting revived. I think the biosimilar, despite company claiming that the market shares, they've been gaining market share, I think the pricing pressure still sort of persists. So from that perspective, I think Biocon does not really look good to us. I think one company I would want to highlight is Philips Carbon Black. I think this company came out with a pretty good set of numbers. We have seen a decent appreciation in the stock. I think the outlook continues to remain equally bright because they are sitting on a capacity of some 7.7 lakh tons and expected to take it to 10 lakh tons in the next 2 years. So from that perspective, this company looks very good to us because there is our sense is that the margin profile can keep getting better, and on top of it, the volume growth is going to be good. So I think this company looked good to us.
Right. A quick check on implied Nifty. It's expected to see a good start this morning. 24,400 is what the market will want to open around and hold down to those levels. We'll take a break. We'll come back, track pre-open trade. Welcome back. You're watching India Market Open. We're gearing up for an exciting Friday morning, but there's going to be lots of stocks that the markets will either reward or not reward, depending on how well they've performed in the quarter. One such company that's had a good run is Galaxy Surfactants. K. Natarajan, Managing Director at Galaxy Surfactants, joins in now. Hi, Mr. Natarajan. Very good morning. Thank you very much for joining us. On the face of it, it's tough for us to tell whether it's been a good quarter and what really lies ahead for you in FY25. So let's start with the picture in terms of demand. Last quarter as well, demand looked healthy. You had guided for a volume growth of 6 to 8%, which you've managed to maintain in this quarter. Last time around, rural demand outpaced urban consumption. Does that trend still remain, and are you pretty confident that you will be able to make 6 to 8 or 8 to 10% volume growth for the rest of the year?
Good morning. Thank you for having me on the show. It's been a good quarter with a volume growth across all the geographies that we cater to. In India specifically, I think things are looking better. Rural demand is coming back. And more important is rest of the world has started coming back with good amount of robustness. So with all this working well, I think we should continue to keep hitting at the higher end of the guided range of 6 to 8% of volume growth. The only caveat here is that the supply chain situation shouldn't worsen from here on. We have learned to manage the situation the way it is, but any worsening of the situation further can be an headwind, but then we remain positive.
Talk about those supply chain concerns, because I know freight costs are higher, lead time is longer, Red Sea crisis is still not completely behind us. But split it up between domestic and your international market, right? If you can tell me what sort of volume growth you're expecting on both those fronts, and what's the market share for exports and the local market as well, would be helpful.
So if you look at India as a market, I think most of our customers have reported volume-led good performance in the first quarter of this year. I think it's been, there have been report of close to about an average of about 3 to 4% volume growth. And we do expect this to pick up in the coming quarters, with all of them indicating that they're seeing good amount of green shoots in terms of rural demand picking up. And with the current budget, which puts good amount of money in the hands of the rural consumers, I think this augurs well for the India demand growth. With regard to the export market, Africa, Middle East, Turkey, after we've continued to maintain the momentum in the last 3 quarters, after close to almost 6-7 quarters earlier of a very tepid growth. We do see that this continuing. And with regard to the rest of the world, which is what was impacted in the previous year in terms of the destocking that was happening and the absolutely low demand in Europe, that has started getting better. And we did record almost close to 25% of volume growth year on year with regard to the rest of the world market. And we do expect this momentum to continue. So this is reflective of the sort of business model we have. So the sort of geographical reach that we have enables us to manage the situation in a way that we are able to grow across geographies, and then able to take care of balancing any issues that we may have in one of the geographies.
Mr. Natarajan, good morning. Tamanna here, and great to speak with you on this quarter. I mean, last time when you'd spoken to us, you had talked about the Red Sea crisis and how this was, making things difficult. Just want to get a sense if this sort of headwind is behind you now, and in terms of how that impacts freight rates and geographical growth, how do you see that panning out? Do you see the big push continuing to come from ROW or rest of the world?
You see, the Red Sea crisis is continuing. We do see the challenges in terms of availability of slots on ships. We have had increased transit times. Freight rates have more than doubled in most of the geographies. Last quarter saw incoming freight situation worsening with congestion happening across all the ports in Southeast Asia and India as well, like Thailand, Singapore, Malaysia, India. All of them had congestions which elongated our clearance time as well. So what we see is that our team has managed to adjust to this new normal, and if things remain as they are, we do see this momentum continuing well, and we can leverage on the growth opportunities that we have in the various geographies, as we have done in the first quarter.
In terms of your segmental mix, just want to understand how the specialty segment is moving or going to go ahead, and how you see that panning out. You've seen a low teens volume growth there. Is that sustainable? And as well as for surfactants, I know overall you've guided 6 to 8%. Does that continue, and what is the mix that you see between these two segments?
This quarter, actually, the specialty segment grew pretty significantly. We grew by about 15%. The performance surfactants grew by about 5%. So combined, we delivered about 8% of volume growth. The specialty segment, I think what we're looking forward is in terms of our premium specialties, which actually got a little bit of a headwind because many of the customers in US and Europe stopped progressing on projects in pipeline because of the destocking that happened there and the low demand environment. Things have started picking up, so we do see in the coming quarters the premium specialty ingredients that we have should start gaining traction. But specialties as a segment, we are pretty enthused with the way that it has delivered over the last 2 quarters, and we do expect this momentum to continue.
So while volumes is solid, demand is picking up. What's happening on margins? This quarter as well, margins have come in slightly softer than what we'd seen in the same quarter last year. You've already mentioned a few concerns and the fact that your freight costs are much higher today. What is the outlook on the margin front? Is there any upside risk to margins for the rest of the year?
We do see margins getting better from here on. This quarter typically also got impacted in terms of the higher freight rates, which gets passed on with a lag. So we do see that getting taken care in the coming quarters. Plus, as I said earlier, the premium specialties ingredients business gaining traction in the developed markets in the coming quarters augurs well in terms of our margin growth as well.
Also, that, of course, is... So I'm assuming the margin range will sustain at this, right? 12.5, 13, 13.5, 14 is largely what we should be expecting as a street. Last time around, it also talked about investing close to 150 crores for maintenance and debottlenecking initiatives. How are you in terms of capacity? And what are the plans there? Any expansion plans? And you've talked about how you're open to inorganic acquisitions as well. So you want to walk us through what's happening on the M&A side of things?
Yeah, first of all, on the EBITDA margin, we typically don't look at margin percentage. We guide the market to EBITDA per metric ton of 20,500 to 21,500. So that is a better indicator of the way that we are able to manage our portfolio. The second, with regard to CapEx plans, it's very much on track in terms of the 150 crores per annum that we're talking about. We do see, and it's happening across India and Egypt. With regard to, I forgot your last question. I think that was with...
About the fact that capacity currently is well managed from what I understand.
Yeah.
Are you looking to add additional capacity, keeping in mind that the future is probably going to be better than the times that some of you and your company, your peers, industry peers have seen in the past?
Yeah, so we currently at about 70% capacity utilization. I think with the capacity additions that we're looking at, we're preparing well for the future because we do see the demand environment is going to be pretty good moving forward. There are some challenges now, but the long-term structural story is extremely exciting, and we're preparing for the future, and we are well positioned to cater to the increasing demand that we're seeing in these markets, both on the performance surfactant side as well as on the special ingredient side.
Just one last point, Mr. Natarajan, is what is the non-organic growth path looking for you for the year ahead or even further? Any acquisitions on the anvil? I think there was some talk that you would be looking at this route.
We are actively looking at, and we have a criteria basis which we would want to move forward. So once all the boxes get ticked, I think we will go ahead. But yes, it is. I would like to say here only that we are actively looking at opportunities, and we should see as to how it progresses in the coming months.
Okay, we'll hope to hear something soon from you. Thank you so much, Mr. Natarajan, for speaking with us. That's the Managing Director at Galaxy Surfactants, speaking to us on a pretty decent quarter. Let's get some quick views in from Kush. Kush is also with us, as is Pankaj this morning, on this company and others which are, in focus. Kush, do you track Galaxy? Anything that you're liking down the charts?
Well, fairly mixed. Nothing out of the ordinary. There's this resistance at this 29.75, 3,000 mark. Once that is taken out, perhaps then you could see some sort of traction coming in. Up until then, near-term trends positive. So if anyone's got a position, no harm holding. Keep a strict stop loss at 27.75.
All right. Meanwhile, let's look at how the pre-open rates have settled. And definitely looking like a good morning. The Nifty has settled about 270 points up in the pre-open session. We're looking set for an interesting day, nevertheless. This is just the pre-open session, mark you. So we'll have to wait and see what the markets actually open at. But in the pre-open session, out of 50 stocks, 49 are in the green. So you're definitely seeing a good morning. iShares seems to be the star of the morning. A good set of numbers, interesting notes on it as well. So iShares there in focus was ONGC, LTI Mindtree, some recovery in IT stocks like we've been talking about. But on the top brokerage call this morning, Harsh is joining us for more. Dr. Lal Path is on your list today, Harsh.
Yes, Tamanna, you're seeing a significant increase in target price by Morgan Stanley. A couple of reasons why that is to be so. One is moderating competition, they believe, in an otherwise, in an industry otherwise dominated, according to them, by Dr. Lal Path. They also believe that there is a re-rating on the cards where the industry as a whole is concerned. So, of course, one is competition moderation for Dr. Lal as well as overall industry re-rating to likely aid the numbers. Now, in terms of its peers, they believe that Dr. Lal has a superior profile both on the execution side as well as the way in which they've done execution in the past. They believe that that's a key going forward, and that's a in that sense is a key advantage for Dr. Lal going forward as well. They've revised their FY25 and 26 earnings just a wee bit post the Q1 numbers by around 0.3% for FY25, around 2% for FY26. But where has that hike come from? They've hiked the target price from 2705 to 3577. They've hiked the target multiple from 44 times EPS to 55 times. Reasons already given, and largely positive and constructive on Dr. Lal, roughly a 12% upside from here.
That's a good-looking report coming in there. The stock is up about 1% in pre-open trade, but remember the broader market reaction is largely going to be in line with earnings. Kush, a couple of stocks that are expected to see a gap up, and I'm going to ask you this because if this shows up, then maybe there could be a swing trade opportunity intraday on these stocks. Fertilizer and chemicals, so Fact is expected to see a gap up. Cochin Shipyard, along with all the other defense companies, is going to get a gap up in early trade this morning. Would you consider initiating any intraday trade, either on a Garden Reach, a Cochin, a Zen, HAL, BDL, and anything in the fertilizer pack as well?
Well, that's quite a long list, and the defense names have actually come back on the radar, almost with a bang now. But I'll hold my horses for some of them. GRSE, Garden Reach, that's the one that's actually looking quite interesting in the sense that it's taken support at the 50-day moving average, holding on the last couple of sessions. The lows have been held except for a minor blip, but this is the one that you'd want to keep on your radar. The risk-reward ratio is starting to turn a lot favorable, in some of these names. So maybe not from a positional standpoint, but a rebound trade standpoint, some of these names are starting to look attractive. So a GRSE is something that you'd want to consider. Also an HAL, we've seen a sharp bit of downturn, but there are early signs of revival on this one. So on the upside, you're looking at, targets of 48.75 and 5,000 positionally on this one. The supports come in at about 4,600, 4,650 odd zones. Fact, yes, we've seen quite a bit of fall, but this too has seen support at the key averages and is starting to turn a corner around. So I think for a target of 1030, which already is being hit at the opening, one could continue to hold fresh trades, perhaps on dips during the day. But since the target is being hit and is coming close to the resistance, I would say don't initiate fresh trades, but hold on to your positions, keep your trailing stop losses intact, close to those 1020 or 1015 levels.
Gaj, very quickly, up until the budget or before the budget at least, fertilizer and defense was a no-brainer. The buy calls were going out, the stocks have had a good run. Some may argue the earnings may not have kept up with the kind of euphoria some of these stocks have witnessed. Do you feel like you would still maintain a buy call selectively in the fertilizer and the defense pack, or is it an avoid for the foreseeable future?
I think fertilizer we don't track, but on the defense side, I think there's some development. So, for example, a key player like HL, there is a potential expectation of a delay in delivery of engines. So, obviously, that will impact the overall revenue numbers for the next 2 years. Similarly, I think when you look at even for Cochin Shipyard, I think we are yet to sort of hear anything on the third aircraft carrier. Garden Reach also came out with a good set of numbers, but I think what we are waiting for is next generation of corvettes or supply vessels. So announcements are yet to sort of happen, and valuations had for most of these PSUs was in excess of 45 times. So I think, and given the price rally which we have seen, I think some bit of a profit taking is not a really bad strategy to do. So our sense is that either the order inflows have to sort of pick up, or probably some bit of a price or a time correction is when we will turn bullish again. Structurally, we are not negative on any of the defense measures.
All right, just about 15 seconds to go before we open for trade this morning. We're going to have a sharp up move, a gap up opening. The question is whether we sustain. Remember, this has been a tumultuous week. We started with a very, very rough Monday, but you have the monetary policy behind you, not too much harm done there. And yes, there you have it, nearly 1% up in the opening tick, about 215 odd points on the Nifty. The Bank Nifty also looking good this morning. Bank Nifty about 0.5% up. Remember, all things considered, Bank Nifty was not too bad. Let's pull up the heat map very quickly just to get a sense of what is working this morning. I reckon Aisha will be top of the list, and yes, it absolutely is. One of its best ever quarters. Their order book has jumped multiple times compared to Q4, and defense has led it. So good set of brokerage notes also on Aisha. ONGC continues its run up once again, and we've been seeing that for some time. As we've been saying since this morning, it's the return of IT companies, LTI, Mindtree, HCL Tech, Infosys, all of yesterday's losers coming up. Auto and IT, I would say, are the big winners this morning. And you can see that in that complete top line coming in. On the losing side, BPCL and HDFC Life. But think of that, out of 50 stocks, 48 are doing fine. Just quick look at the broader indices before Samina comes in with specific stocks which have been buzzing, because this is an all-round decent Friday for the market. 1% up on the mid-cap 150, and we'll pull up the small cap doing well as well. So, Samina, it's the result-oriented stocks which are running, and a whole host of others, I suppose.
I think everything that sold off yesterday is doing a temporary recovery in today's day of trade. Of course, it's going to be a turbulent ride. We do know that just because the markets are up today, we're not completely out of the woods, and it's still a difficult market to trade, especially if you're a trader. Well, the breadth of the market's good, and that's what we will take off from this morning. But 24,400 is important on the index, and that was the current week's high. So if that does get taken out, there'll be a little more conviction in the texture of the market. But let's take you through what is moving. It's been a whole bunch of earnings. Most of them have been actually pretty good this morning for the broader markets. But I'll start with the standouts. ABB, Cochin Shipyard, HPL, if we can pull that up. Cochin Shipyard up 5%. A couple of reasons why the stock is doing well. While the numbers have looked really good year on year, quarter on quarter there's a decline. But let's not forget that these stocks were down and out over the last few days. So there was a little bit of a reason that they were seeking for a recovery in trade, and that's what you're getting this morning. After a 19% sell losses on the stock this month, the stock is up 4.5% this morning. You've got ABB as well, very, very good earnings. Now, this is one counter that may potentially go from strength to strength, because they've reported 3 strong quarters. This is the 4th one, and the outlook looks even more promising. So 1.5 to 2% higher on ABB. HPL Power, relatively small company, but phenomenal earnings coming from their stable as well. 3.5% higher on that one. JB Pharma did quite well. If we want to pull that one up, we should get a sense of what the markets think about it. 2% on JB Pharma is what we have. Aisha may potentially turn out to be the biggest stock of the day. Very strong earnings. The outlook is positive. Most of their verticals are doing really well. They've seen the best quarter in terms of profitability and revenue. All that put together means Aisha is up 4.5%. JB, of course, hit the 1,000 crore mark in terms of top line as well. LIC, again, good quarter. 1.5% higher is what we have. Well, those are, of course, the big gainers. You've got, I'm going to quickly mention Concor and Ircon as well. If we can pull those up and see how those are reacting to their earnings. Concor was average. The stock is trading flat, and Ircon as well, not doing too much in early minutes of trade. Well, in terms of the companies that reported earnings that have disappointed the street, I'll start with a few. Birla Corp, very bad quarter. It's been a disappointment on every front. The stock is down 4% as we see it. Soba, on the other hand, was mixed in terms of pre-open trade, managed to cross over the hump and is trading high by 1.5%. SAIL and Bayer Corp, if we can get those two up as well, we should get a sense of what's happening. Bayer Corp down 6%, weak earnings, so no more surprises there. And you've also got Bayer Corp that's down 6%. So that's the market texture. It's largely earnings driven, and that's pretty much what it will remain for most part of the day. Stock specific trade will drive the street, but the broader sentiment, Tamanna, is positive on back of what we've got from the global marketplace this morning.
Yeah, looking like a very, very good morning. And, I can't take my eyes off Aisha. Aisha definitely the stock this morning. Kush, what would you do with an Aisha right now? 4.5% up at 4772.
Well, I'd probably take some money off the table. It's seen a sharp cut. The rebound was around the corner, and we're getting that. Even if it's been just 4 minutes, it's come up to that resistance mark of the 20-day moving average. If I did have, a position, I think I'll perhaps be at cost now, and I would take some money off the table. If this momentum does indeed take it above this, 48.50 mark, then there is a possibility that it could move higher to those 49.75, 5,000 zones. So at least take some money off the table because it's hit that resistance, and it's been just 5 minutes, but not really sustaining, at the moment.
Just a quick mention of a few other names that are doing okay in trade this morning. So while the Nifty is up, the Nifty 500 also continues to see a gain of 1%. KFIN, that's the top gainer on the Nifty 500, up about 8%. You've got Bombay Burma, so trading companies back on 5.5% high. Cochin is your top gainer. Godfrey Phillip is seeing a little bit of a gain. Like we said, tech would be seeing a rebound today after yesterday's sell-off. So your broader market tech companies also looking quite good. Pankaj, I don't know whether we talked to you about Aisha, but you want to come on this one? It's turning out to be quite the stock, and rather the stock of the morning. Very strong outlook. It's been a record quarter in terms of revenue and profitability, and we believe it should be good going for them going ahead as well. Would you look to adding Aisha Motors tactically, at least, if not strategically?
Absolutely. I think one good thing with Aisha is that long-term P multiples for this company has been about 30. It's trading at 25 times. So definitely there is a valuation comfort. On top of it, I think the product mix is changing towards higher, greater than 350 cc segment. And I think overall, our sense is that even in the numbers, if you look at, we are seeing improvement in the gross margins, obviously helped by the lower commodity prices. So I think Aisha comes out to be a good, attractive play on the premiumization of two-wheelers. So from that perspective, we continue to like this stock. We had a previously buy rating. We'll work out the numbers, but I think there's not much to sort of complain with Aisha, except for the fact that recent 1 or 2 months, the numbers are not that great. But structurally or from a portfolio perspective, we like this.
Thank you so much, Pankaj and Kush. Great speaking to you this morning. All right, we have a very special segment right now in our studio. The top team of MK, Krishna Kumar Karwa, the Managing Director, with us this morning, Sheshadri Sen, Head of Research and Strategist, and Nirav Sheth, of course, CEO of Institutional Equities at Emkay Global, with us. So the reason we have the top team of MK in is because they have their conference coming up, which will be featured exclusively on NDTV Profit. So remember, if you want to tune in for a lot of those interesting conversations, here's where you need to be. But sort of to set the stage, and welcome, gentlemen. Great to have you in our studios. Yeah, and on a great day, on a good morning when markets are seeming good, but after a very, very rough week and a bout of volatility, uncertainty, whatever you call it. Now, your pre-conference note, I was going through it, and you talk about how India's fortress balance sheet will withstand all rough weather. Let's start with that theme, because if anything, the events of the recent week have shown us how susceptible we are to global weather. Right? Mm-hmm. We are tracking what's happening in US markets very, very consistently.
So let's look at it this way. Okay, we are tracking global markets, no doubt, but last 3-4 days, FPI sold some 17,000-18,000 crores worth of stock. Domestics again bought 17, 18,000 back to back every day. Whatever they sold, we bought. So that's the resilience of the Indian domestic investors. Yes, there can be stock corrections. Coming back to your theme about the resilience of India's balance sheet, look at our fiscal deficit, look at our current account deficit, look at the corporate balance sheets, hardly any debt on them. So corporates are very strong. India is very, government is managing the show very strong. And in fact, even in the budget also, they reduced the fiscal deficit target versus what they did in the interim budget. So all this gives you hopes that yes, there can be global turbulences, etc. But Indian economy will continue to move forward, and so will the corporates will keep on delivering. There will be bouts of valuations which will be euphoric or out of whack, etc., where there will be corrections, etc. But corporate balance sheets, actually that's what we should be focused on, and they are very, very strong.
You use two words, euphoric and out of whack, to describe valuations. Is that where we are right now? Euphorically out of whack?
No, there will be segments. There will be segments where could be valuations could be which you cannot explain, and where there are momentum in the sector, etc. But maybe are we discounting 3 years down the line, 4 years down the line? That could be a possibility. But at the same time, there are opportunities where valuations are reasonable, where sectors have gone through their own consolidation in the last few years, and that's where the opportunity for investors to invest in is there.
Mr. Sen, I'll just start with the more recent event before your note. RBI's maintained a hawkish stance, largely in line with what we were expecting. How do you view the local rate cycle playing out in the near to medium term and the impact of that on equities?
Well, in the near term, we don't think there will be too much change. I think the RBI's comments, despite 2 members voting for a rate cut, made it clear that until inflation is brought under control, the RBI is not going to do much. However, if the Fed does start cutting rates later in the year, some say September, and we don't know, the data changes almost every 3 days. Then the RBI may be in a position, may have to start looking at cutting rates. But we don't think that that's a major, if you take a 1-year view, rates will obviously be lower than where we are. But if you take a 3-month view, then it's a little more difficult to forecast. But the bigger point is that look at where the 10-year is, right? We're at the peak of the rate cycle, and the 10-year is below 7. I mean, I've been covering Indian markets since the 90s, and I can't remember peaks being so low, meaning we used to have 9s and 9.5s on the 10-year in previous peaks. So I'm not sure that is a point we need to worry about, and the fortress balance sheet argument is, this is one of the manifestations that on the bond yield side we are peaking at much lower rates, and that gives us resilience to any global turmoil, any domestic turmoil. So I'm not sure that we, as equities investors, we need to worry too much about the rate cycle. But from 1-year perspective, I think the RBI will be cutting, and a lot of that will manifest itself at the lower end of the curve and not the longer end of the curve.
Right. Nirav, you talk to big institutional clients all the time, a lot of them sitting outside as well. What happened to Japan or South Korea or any of those other markets. But at the same time, we were looking stretched even last week. Do you feel like much has changed in terms of mood and sentiment when we look at the markets? Is the rally done for now? And when I say I don't expect a big correction from your own, but do you think we may spend extended periods of time consolidating at these levels before we make the next big jump?
So, it's fairly likely that you can have a period of time correction and all. But let us just try and put this in context, right? So all of us get very worried about market making new highs. GDP makes new highs almost every day. That is usual. Now, look at the last 10 years. Just before you had this pullback in Japan, right? Yeah. Japan has given a local currency return of 12% CAGR over 10 years. India, till last week, was 14%. Now, Japan is an economy where the nominal GDP today is lower than what it was 10 years back, right? So, let us get this thing right, that India with $4 trillion economy growing at 7%, earnings growing at about 13-14% is an island of growth. what creates a lot of discomfort to a lot of us is the fact that the markets are getting re-rated, right? So all of us can make an argument that, earnings were just about okay in the current one quarter. That is what the re-rating of the market does. It makes you nervous. The fact is that you need to look at what's going to happen in the next 2 or 3 years. Where are we heading in terms of our currency? Where are we heading in terms of interest rates? Where are we heading in terms of required rate of return? Right? So, to me, the entire grounding of this bullish market is backed by a very, very strong bullish economy. Look at the participation of the breadth of the economy. Right? So, again, if you just look at the credit growth, and if you look at the credit growth for the mid-cap sector, and if you look at the SME sectors, this is RBI data, that is growing upwards of 20%, while large corporates are growing at the rate of about 4%. So it's democratization of earnings, large participation, strong, large number of companies getting listed. So right place, right time.
In this, do you think that the consumption part of the puzzle is also falling in? Because that was the question mark, right? That you're not seeing that much private capex coming in because at the end of the day, consumption is not catching up. Now you have every company in that space coming and saying rural is outpacing urban for me this quarter. Do you think that's also coming into place to complete that picture that you're talking about?
Yeah, so part of that is that you can make an argument that to some extent, anecdotally, when you look at what the companies are saying, that a part of rural is coming back. To me, please let us appreciate that India is a very, very small pocket in terms of the listed entities and their contribution to the GDP.
Yeah.
Right? So when you are talking about the fact that consumption is not doing well, I would argue that when you look at an aggregate data, again, so I'm just coming to the same point. Look at what's happening at Flipkart. Look at what is happening at Amazon. Right? So millions of small outlets getting listed over there, and they're chirping away a part of your sales growth. Right? We are seeing that in terms of April. So, which is why, to me, it's broadening of the economy to a large extent. That is what is happening. Investments, again, right? So, you are only looking at listed entities. Now, if you look at investment to GDP ratio, I think that has gone to some 37%, and we are doing very well. So, I don't think there are any reasons to complain. So, you're putting tons and billions of dollars in data centers and warehouses and all that, and they are not in listed space by and large.
Okay, so a lot of growth coming from the unlisted space. Understood. Where is the growth going to come from in the listed space? Mr. Sen, let me come to you. I think your report talks about the manufacturing theme dominating, and that is going to really push through more of the SMIDs. Now, this space is being seen with a bit of caution because of the kind of run-up. Some of the valuations are frankly not making sense right now. But do you think that they will catch up in growth?
Oh, definitely. If you look at the fundamental cycle, this is a cycle of manufacturing over services, of investment over consumption. This is the long-term cycle that we are in. That doesn't mean consumption is dead, but the relative growth of manufacturing over services and investment and capex over consumption will continue. That is not about to abate. But you're right, valuations do matter, and some of the valuation froth or the excess valuation that had built up in some of these manufacturing sectors have already come off, right? In the last 2 months, you've seen some of these stocks having corrected quite deeply. You see industrials, which is probably the highest growth segment in the sector in the economy, having underperformed for the last 2 or 3 months. And those will continue. Those sector rotations will continue, probably in a little more fierce manner than we have in the last 3-4 years. Like the secular run that you had of manufacturing in terms of stock prices will now see a little more balanced stock performance from here. But if you take a 2 to 3 year view, these are definitely remain the outperformers, we think, because the growth that they are going to deliver is far in excess of what consumption and services will do. So, yeah, meaning tactically you could play around with the sectors depending on valuations, and I do believe that in this post-COVID market, valuations matter. The market's been pretty brutal on overvaluation and in a very short period of time. But if you take a 3 year view, these are the sectors which will continue to drive out performance, and both in terms of growth, earnings growth, and stock price performance.
Mr. Karwa, coming on that, domestic cyclical sectors have been the primary drivers of earnings growth. So be it real estate, be it auto, be it consumption, BFSI, they've done okay. Global cyclicals, on the other hand, are still struggling. So be it in IT, metals, oil and gas saw an 80% decline in profits YOY. I'm going to throw in specialty chemicals while we were in a conversation on that too. What have you made of earnings, and what is your Nifty EPS estimates for the current year and the next year? Have you gone back and reviewed those after looking at what the India Inc. has posted?
So the earnings have been a mixed bag. I think there have been a decent amount of, most of the time, you have seen not great outperformance across the board, and there has been slight misses also. So it's not been a one-way positive as far as the earnings season has been concerned. There have been disappointments, and markets have been very ruthless wherever there has been disappointments. And I'm not too sure where even results have done better than expected. The uptake has not been so sharp. So which means that kind of discounted or topping out. So that is there. And sorry, I just forget the second part of the question.
So what is your EPS estimates for FY 25-26? Have you gone back and reviewed it?
No, I don't think so that we have seen any cut in our overall earnings estimates.
Generally
I think it's broadly on track. And if I understand, and Shen can correct me, I think we are at around 21 times Nifty earnings. Market valuations are around 21 times, which is broadly in sync with the averages as such. It's not very, very ahead of the averages as such. So I think it's a fair value as far as the overall Nifty is concerned. What you can say is that within that, how the earnings are playing out, I think maybe banking, etc., seems to be under pressure. That's the sense that we get.
Nirav, you come in on this one for me. You talked about how India, over the long term, CAGR has been about 14%. We've had a dream run in the last couple of years. So very clearly, we've borrowed returns from the future if you're an investor. I know it's always easier said when you say it's the time in the markets, not timing the markets, but all of us do feel emotion when the markets fall and your portfolios decline, and you also feel joy if you manage to time it correctly. What is the advice for investors? Are you taking a cash call right now? Would you say take some profits off the table, go back and rebalance your portfolio, and maybe if you get a 10-15% correction, you double down? Or are you saying continue with the SIPs, because at this stage it's really too tough to call it a top or a bottom?
So, like KK was just referring to...
And hedge yourself.
No, we don't want to hedge ourselves. So, I'm fairly, very constructive on the markets. And by definition, when you're professing someone to do SIPs, you don't want to take market calls, right? The whole idea.
Yourself.
Exactly.
You're saying, I don't know where this is going, so just keep adding.
No,
and 10 years later, you'll forget about it.
I think I'm again coming to the same point of time. I believe that your earnings growth rate are likely to surprise rather than not surprise over the next 3 years.
Just before that, did you buy on Monday when the markets fell? How much incremental capital did you allocate? Stick your neck out and tell me that.
Let me tell you that I am 100% invested in equities.
So, no cash on the sidelines?
No cash on the
sidelines. So, you could not make an opportunistic investment on Monday?
Absolutely.
Sadly.
Again, let's appreciate the fact that you are talking about trying to take money out of the market and invest where?
Debt,
it's always something. So, that is 5.5%, and then you pay tax on that, right? So, I think the dividend yield even right now would be 1.5%. And you're talking about another 4 or 5% CAGR.
So if you have fresh money that comes in, you are still saying, I'm going to put my full 100 rupees in the market. I won't time this.
Absolutely. So I'm saying is that you're looking at the broader market. So there are pockets, there are euphoric pockets. I'm not very sure what you do with the railway stocks, the defense stocks. I'm no expert on that, right? I'm saying is that if you are, if you want to look at ideas where there is some amount of value, if you are willing to do hard work, please come to our conference. We'll show you a host of companies, and I'm sure we'll see a lot of value. So I think there are enough opportunities in the market.
Yes. What you're saying is that there is something called risk appetite and asset allocation. So I think investors should be only focusing on that. Okay, what is your risk appetite and what is your asset allocation between debt, equity, etc., etc. And if you are regularly monitoring that, then you will never have such challenges, because at time to time you will be balancing. I think that is what is the key. But to exit your equity portfolio, then get in again, and those kind of things is not going to work. Stock specific, if you are looking at it, then you have to look at the individual valuations at every point of time and what is the incremental returns on the stocks that you hold. And if you think that probably they are discounting 2-3 years ahead, then you should look to book profits. I think cash calls doesn't make sense for a long-term investor. You can be lucky a few times, yes, you can be, but generally you will not be. You have to go through cycles. I mean, you only discuss about multi-baggers. Now, if you're going to have multi-baggers, that means you have to hold for 5, 7, 8 years, and there will be so many such events, right?
Yeah. And you've got to do the hard work, right? You've got to pay the price for making the gains. There's no free lunch.
I just want to come back to the point quickly that you made on financials and tie this in with some of the comments we heard from the Reserve Bank of India governor yesterday, talking about the difficulty they're finding in deposit growth. Yes, credit growth has been great. You talked about that, Nirav. But the deposit growth side of things is looking a little tough. Do you see that as a problem which blows up over the next few years as far as financials go? It's a catch-22, right? How are you going to attract those household savings in? How are you going to grow deposit growth when, as Nirav explained, the markets are giving such a better return? So does that put a bit of a question mark on financials for you?
Absolutely. I think we have come out on a very cautious or a kind of a negative note on the banking sector a few months ago, because we believe that this sector is highly regulated. So it comes with, if it is doing too well, the regulator will come in to control it, because you have to do that. So there is only so much of growth that this sector can show. And there are continuously, so that's one challenge. So profitability will always be under pressure. And if versus global comparisons, our banks have very high profitability. So we will tend to go towards global comparisons. So that is going to be another challenge. And when the economy is doing well, then you don't, it doesn't make sense to invest in banks. It makes sense to invest in actual businesses. Like whichever sector, the capital goods sector, materials,
what are you
etc.,
liking the best right now?
I can't say stocks, right?
Not stocks. In terms of spaces, when you say actual businesses, in terms of spaces.
Right.
No one knows what to do with IT, for example.
No, IT is not a sector because that's not India focus. That's more global focus. It's a very, very large sector which can only grow at some 7, 8, 10%. That's not the sector where you can grow big time. You will have to. There was the defense and the railways, etc., that you did well. Probably some of the sectors which are now coming back, maybe it could be specialty chemicals. It's gone through a two-year consolidation. Maybe it could be agrochemicals.
Pharma?
Pharma has already done well. It was consolidating, but now it has made its move. So you will have to look at those sectors where you can have a multiple expansion apart from earnings expansion. And in banking, possibly a multiple expansion is not happening. We have seen a continuous degrowth in the valuation multiples of banks.
Right, so while taking a cue from that, and Mr. Sen, you can comment on that, while banks may not have it very sweet, NBFCs are doing quite well, and I'm categorizing everybody who does non-banking as well, so private banking companies, anybody playing the financial space. So we saw those numbers from BSE and NSE yesterday. Phenomenal. You look at what a Nuvama is doing, you look at what the 360 is doing. Of course, those are also expensive when you talk about the likes of Anand Rathi. Do you think a better way to play the financialization theme in India may be through some of these instruments?
Yeah, you asked for two separate categories. NBFCs, in the short term, when the RBI starts easing, tend to benefit, at least in terms of perception.
So tactically could be a good play.
They are covered by the same issues that we were just discussing on the banks, that there is very tight regulations. Banks need to take risk. Banks and lenders need to take risk to make ROEs. The RBI, very correctly, is keeping a hawk eye on risk in the system, because we as a country have not taken risk in the lending side very well, right? When risk has built up, it's always ended in tears. So we think that regulation will continue to be tight, and it will be more and more difficult for lenders to make excess returns by taking risk as we go along. And in the meantime, there are some asset quality issues in certain pockets in the next 12 months. So NBFCs are different. Capital market subsidiaries, if our narrative plays out that we're in a long-term bull market, then the penetration of capital markets in the retail space is still very low, and that's to your question on deposits, I think this will continue. And it's inevitable. We can't expect to go from 2,000 to 3,000 per capita income without more retail participation in the capital markets. So that's a theme. The only warning is that capital markets players tend to be deep cyclicals. When they do well, PEs and EPS expands. When it turns, both collapse.
So you'd avoid the space of wealth managers and capital market players?
Maybe wait for corrections if you get, but you're not going to get them, 2 years earlier when regulation, and that's also regulated space. For example, if you look at the AMCs, when regulation was becoming very aggressive, you got some of those AMCs at dirt cheap valuations, and some of them have doubled and tripled from those levels. But, I would still keep an exposure in the capital markets
that you
place.
absolutely adore and think valuations are compelling, earnings are great, and the outlook is positive?
You don't get that trifecta anywhere in the bull market. So I would still say consumer durables, the auto and auto ancillary space is still pretty attractive. I think the cycle will remain strong. Again, on any sector, you have to be mindful of valuations, but that's one sector which I really like.
Okay, so more of this conversation from the Emkay conference. So stay tuned for that. But thank you so much for coming in. We'll take a very short break. On the other side, we're speaking with Nikhil Chopra, Chief Executive Officer of JB Pharma. Stay tuned.
Welcome back. You're watching India Market Open. There's lots of Friday cheer on the Dalal Street. The markets are holding up, and companies that have reported earnings are getting quite the reaction. One such company is JB Pharma. Fantastic set of earnings. They've also crossed the milestone of 1,000 crores in terms of revenue. Nikhil Chopra, CEO at JB Pharma, joins in to walk us through how the quarter's been and what's the outlook for the company going in. Hi, Nikhil. Good morning. Congratulations. You've hit the 1,000 crore milestone in terms of revenue. So I'm guessing everybody at your end is extremely cheerful and excited. But let's talk about what went behind that number. Give me a sense of what top line outlook is looking like, and what was it driven by? How was the domestic formulation business looking? And of course, revenues from your international business, because I do believe that was quite flat this quarter.
First of all, good morning to all of you at NDTV Profit, and it is my pleasure to be on the show. And rightly so, what was shared that we have for the first time in a quarter across 1,000 crore revenue and growing at mid-teens, around 12% for the quarter. And this was basically more driven by the performance that we have demonstrated in India business, which we have been talking about. India, we shied away touching 600 crores for the quarter, and the revenues grew at 22%. More so, what has been happening is not only in terms of revenue that we have achieved, but what is more heartening is the improvement in gross margin. Our gross margins are as high as 66%, and what guidance we've been giving for our EBITDA margins, operating EBITDA margins between 26 to 28%. I'm happy to inform that our operating EBITDA margins for the quarter were 29%. That is where we stand. We saw some softness in our rest of the market business. That is more so in the world of CDMO and US. Emerging market, that is rest of the world, grew at mid-teens. And the way we see overall incoming couple of quarters with robust order book, our emerging market as well as our CDMO should also start showing around 12 to 14% growth in the coming time. That is where we stand. And what has been happening in the
Yes, please. I wanted you to dwell on the CDMO piece because seasonally it's the second half of the year that is not as good as the first half. But you're saying that this time around, third and fourth quarter will be much stronger, right?
So this business has a flow in terms of the way it happens. The trajectory continues to be 100 crore plus every quarter, and the way overall climate change and the dynamics are behaving, we see more and more flu season and winter season starting September onwards. And the way order book is today in place, September onwards, we see a better trajectory for this business. And there are a good number of new development projects which are on. Today, more of our CDMO business is happening in the world of cough and cold for our lozenges, which is 80% of our CDMO business. So there are half a dozen new projects which are on. So those new projects will come in, the lozenges for sleep disorders, for immunity and wellness, for motion sickness, for antifungal lozenges. All those things will be in place. So that all things will start reflecting probably quarter 2 and quarter 3 onwards. That is where we stand from the CDMO business. But what I wanted to also talk about is a strong performance that we have demonstrated in India business, where our overall chronic part of the business has been the highlight in terms of the way that has contributed, and that is contributing to overall improvement in gross margins. And we continue to be the fastest growing company in the cardiology space, particularly in hypertension, heart failure, and lipid products in India business.
Indeed. So you're right. Your margins have also been a standout in this quarter. And I know the company has undertaken cost optimization efforts, which is, of course, bearing its fruit as we see it. For the rest of the financial year, where do you see your operating margins at? Should they see further improvement? Is that an internal expectation?
We'll be more than happy if we are able to maintain this gross margins of 66%. And operating margins, the guidance that we've been giving. Also, a couple of points that I would like to talk about in our rest of the world market, particularly about Russia. Russia has done fairly well. Our absolute EBITDA value has been growing at a pace of around 30% plus for the quarter, and that is what we will see for the coming 3 quarters. And also the South Africa business, where in last 5 quarters we have taken a hit of around $20 million. Quarter 2 onwards, we'll start seeing the growth in our South Africa business, which will also contribute to overall profitability and EBITDA. That should happen.
Mr. Chopra, I'm glad you bring up Russia and South Africa because those are your key export markets as well. What is the sort of percentage growth you're expecting these markets to grow by for the rest of the financial year?
So India, first of all, India should grow at around mid-teens. That is what we'll be able to demonstrate for next 3 quarters.
Right.
Within our rest of the world market, South Africa, Russia should grow at around 9 to 10%. That is where we are. Emerging market, that is rest of the world, where we are present in 4 clusters: Sub-Saharan Africa, Latin America, Southeast Asia, and Middle East, which business is around $12 to $14 million every quarter, should also grow at around 12 to 14%. And CDMO space should see around high teens growth in quarter 3 and quarter 4. That is what is a guidance for the coming time. Yeah.
Right. So you've also added ophthalmic brands to your portfolio. You're 5 months into integration. What are the key learnings? What is it that you see in terms of outlook for the ophthalmic vertical?
So this business last 3-4 years, if you look at which was with the products which were marketed by Novartis, the revenues that we got in, and this is an in-licensing cum distribution arrangement with the revenues which we got in were 165 crores. And the trajectory that we see for the current year, we should be close to around 190, 195 crores for the year. And this business, by the way, was not growing for last 3-4 years. Basically, 50% of this business comes from the products which are in the world of glaucoma, which are chronic in nature, where we are seeing more and more adoptions. 65 people from Novartis joined us, and today the field force is 105, which will be eventually 120 people working. And we are looking at this business to grow at mid-teens, because ophthalmology market is dynamic in nature in terms of flu season, in terms of the eye infections are there. And also in next 2-3 months, you should see us getting into the world of dry eyes, in the world of biologicals. All those portfolios will come in. And we are very excited with this portfolio. And also to share the 10 brands that we are in license and distributing. Out of this, 5 brands are leaders in their category. So we'll continue to attain the leadership and grow more and grab more market share. The number of ophthalmologists which were covered by 65 reps which came in were close to 7,000. Today we cover close to 12,000 ophthalmologists. So a lot of coverage has improved, distribution has improved, portfolio will be added, and we will look at how do you propel up the existing portfolio, where today we are leaders in 5 of the brands. That is happening in the world of ophthalmology.
It looks very exciting. I would love to talk to you more and, of course, understand from you on your acquisition plans as well, because that's something that the markets always get excited about. But I believe you've got a meeting, so we'll let you go. We'll try and connect back and get a better sense of what's happening at the company. But good luck and congratulations on a fantastic quarter for JB Pharma. On that note, we'll wrap up India Market Open. Thanks for watching. But up next, we talk to Amit Kalyani, Joint MD of Bharat Forge, to get an understanding of the quarter and what lies ahead in FY25. Open. This is an interesting morning. There's lots of cheer on Dalal Street, but more importantly, there is also a new kid on the block. The much anticipated Ola Electric Mobility is set to list on Dalal Street anytime now. The 6,156 crore IPO was subscribed by over 5 times, with the retail portion being subscribed by 3.92 times. So lots of excitement. We will be tracking this in a minute or so when they, of course, list on the exchanges in a few minutes from now. Well, all eyes will be on the listing now. We had, in fact, earlier caught up with the company CMD Bhavesh Agarwal and CFO Harsh Abhichandani. Here's what they both had to say about the company's growth path to profitability.
the operating leverage kicks in, we are expanding our scale, etc. So the path to profitability is very clear. I would not put a time frame to it. That will be like forward looking, but the path to profitability is very clear from our perspective. If you look at from a cash flow perspective, our core business is obviously had a different cash flow profile, but where are we investing in the future? We're investing for growth. We're investing for expansion in the future. It has also been discussed in our book. We are raising capital for our sale in the IPO. We are investing into R&D, etc. So all these, kind of factor in terms of the way the cash flows get generated in the future. And in manufacturing, I think as Bhavesh also mentioned, as we scale up, the path to profitability is extremely, faster. So our scale is important for us. So in cash flow, profitability is absolutely there on the anvil. It's not something which is there. The analysts look at it from a different perspective, from a capex perspective. But our capex also is largely well funded in a larger roadmap, both for the auto side and on the sales side.
Well, that's the management of Ola charting it out about when the company will turn profitable. This was, remember, a much anticipated listing on the exchanges, got quite a touch to consumers and retailers, and that's what gives this one a bit of a touch. Well, that is the management of
all right, I hope you're all
getting excited for their listing this morning. Right. Well, it's going to happen in the next 1 minute or so. Remember, it'd be exciting to see whether this lists at a premium. It was oversubscribed in the retail part of the book by 3.92 times. And it'd be exciting to see whether this gets snapped up. It was some argue that this is an expensive company at the valuation that it was. And hence, that could and potentially have an impact on how the company will list. But for now, lots of excitement, euphoria in terms of that listing. It's a very muted start for Ola Electric, 2.5% higher. So it's not down, but of course it's not as excited or as euphoric as the management would have potentially liked. For now, flat to slightly higher start on Ola Electric is what we see. Well, apart from that, it's all about earnings, like we've been saying. It's Bharat Forge now that has reported its earnings. The first company that we're now going to talk to is going to be them. They will be, of course, walking us through their quarter numbers. And while their revenue and margins have grown, the profit is down by over 18%. This is on back of the one-time provision of 150 crores for one of its investments. To talk more about these numbers, we have with us Amit Kalyani, Joint Managing Director of Bharat Forge. Hi, Amit. Good morning. Thanks a ton for joining in. Amit, it's been a good quarter. You've seen a growth on most parameters, one-time provision that's impacted profitability. But let's talk about top line. Defense is the key growth driver for your company, currently contributes 15% to your top line. Tell us where you see that and how you see that play out for the rest of the financial year.
So, as we mentioned, our defense business started generating revenues 2 years ago. It was about 500-600 crores in that year. Then it grew to above 1,000 crores in the last year. This year, again, it will grow in the vicinity of 2,000 odd crores, maybe slightly plus minus. And our goal is that in the next 3 to 4 years, we should again keep growing it manifold, so possibly double or more in that time. And quite frankly, we are very bullish on these prospects because we are seeing tremendous traction from global markets, and it's not just India that is going to be our market. As it is today, over 90% of our business is exports, and I think the products that we have developed and whose IP is completely owned by us, and we do everything vertically in-house, give us the capability to service large global markets with high value and significantly value added products at an extremely competitive price and gain a large market share. So I think the potential is large, and we hope that this business will keep growing.
Exciting. 90% of your revenues come from outside. So tell me, where do you see and how much do you see exports of defense grow by in this financial year and over the next 2 to 3 years?
See, as we've mentioned, we have an order book of about 5,800 crores roughly, which is all exports. And in addition to that, we have large domestic programs which will now the tendering is all over and the price bids will be opened. And there are 2-3 other new big programs in India. So products that are being developed with a global view, but to keep the Indian requirement in mind as well. So, as I said, these are high value added products, and they are global in nature. So we expect to see large opportunities unlocking from this.
Talking about opportunities, we believe AT-AG is the next big opportunity for Bharat Forge. You want to tell us what is the size of the market, what is the sort of market share you're working with and expecting, and where do you see that, and how much do you see that contribute to your top line over the next 2 to 3 years?
See, we have 7 gun platforms in all, artillery gun platforms, with several different variants of each. So all put together, we can mix and match and make many more variants. So these variants are from 105, 155, right from 39 cal to 52 cal, and potentially go beyond that in the future. We have mounted guns, we have towed guns, and we have self-propelled guns. So a combination of these, the requirement just for India itself is 4,000 numbers, and globally will be significantly in excess of this. So I think the opportunity is very large, and we will pursue this business. The other thing that we're doing is also building up a revenue business in the defense space, which is spares and consumables, which itself will become a significant business in the next 2 to 3 years.
Right. You want to tell me if you've got any local competition in the ATAC space?
Well, of course, there's a second development partner, which is the Tata Group, which has also worked in co-development of, which is also the co-manufacturing partner of the ATAX gun. So these are but their product overlap we have there is the ATAX gun.
Right. Let's talk about the overseas subsidiary, because that still remains in a loss. What is the outlook there, Amit?
So as we've mentioned in the past, we're working towards, a path to profitability, and we're quite confident that by Q4, we should be at above break even. Unfortunately, the volumes have been a little weaker than anticipated because of issues ranging from the Red Sea crisis and overall demand reduction in Europe a little bit, to one of our customers having a specific issue in the US market, which has reduced our offtake temporarily. It's not anything to do with us. It's something to do with some other supply chain issues they're facing.
And Amit, there's that 150 odd crores or that one-time provision on investment in Tork Motors. You want to tell us what this is on back of and shed some more light on that for our viewers?
So very simply, we are an investor in a company called Tork Motors. It was founded by a bright young man from Pune, and we invested in this company over the last 4 to 5 years in multiple tranches. And then with the withdrawal and the reduction in the FAME scheme, the profitability of the company reduced. And, I think it's prudent for us to take a provision, because we are, as I said, we are an investor. If the company is in a situation where we have concerns over its going concernability, we have to recognize that and take a write down. We don't run the company. It's run by its CEO and managing director and the KMPs. And that is the decision that has been taken. So that's what we have done.
Right. So fair for me to understand that this is just an investment that's gone bad, and the 150 crores represents the complete investment made by your company in this company?
Yes,
there could
absolutely.
be some more we'll see in the next few quarters.
No, we have written off all our investment in this company so far.
Okay.
And obviously we're working towards, working with them to see how we do a orderly wind down. But as far as our investment is concerned, this is the large part of it. As you mentioned, there may be some remnants, but this is a large part of it.
Right.
Very, very significant.
And
90%.
No write backs can be expected either, right, Amit, going ahead?
Well, never say never, but I don't foresee that right
so prudent to write it off as a provision, and then of course what happens later is always a cherry on the top. Very ambitious fundraising plans, 2,000 odd crores, which has been approved by the board. You already big time on the export map. So make in India, sell outside, make in India, sell more in India. What is this 2,000 crores going to be used for?
So it's very simple. We see tremendous opportunities in several of the business sectors that we are present in. As you're aware, we acquired a business in Coimbatore called JS Auto, and then we acquired a second one called Indo Shell Manufacturing. And these are both foundries in the iron and steel space. And we are seeing tremendous growth opportunities in this sector. When we bought the company, it was about 450 crores in sales. I think just in the 1.5 years since we bought it, or 2 years since we bought it, we will almost grow it by 60 to 70%. And the future growth rate looks very promising. And we want to be able to both do capex in these areas where we need to build capacities to service the market. And there are certain other areas where we will target inorganic growth, but in India. So by acquiring assets or businesses in India to service both the growing demand in India and to export from India.
Amit, also I believe the company is working on cost optimization, and that's quite the focus for Bharat Forge. Is it a fair expectation for us that profitability then in that case will only improve, and there's a very clear upside risk to that in the next couple of quarters?
So look, if I put it in a different way, what we're doing is bringing down our break-even level, improving our product mix, increasing the product diversity and customer geography, and de-risking the business further. De-risking the business further. And when do you think we can see that reflecting on your earnings or your margins or your EBITDA? Well, if you look at this quarter also, our EBITDA margins were extremely strong. Yeah. They were 28% plus. So it's clearly reflecting, and it will continue to do so as long as the revenues remain at this level or so. But, we still continue to do some cost reduction, business optimization and the use of digital technology to reduce cost and to improve productivity significantly.
That's amazing, because that's what we've been all talking about, right? It's AI to improve and enhance efficiency, and that's got to reflect on the numbers eventually, which in your case is already showing. Now, one spoiler, Amit, is the CV demand in Europe, right? Which was rather a stable, good quarter for Bharat Forge, but CV is still struggling. Do you feel like this is probably the end of the pain for the CV sector, and going ahead, gradual recovery is underway or could potentially be underway?
So, two of our large customers have projected a good year for next year. And on top of that, we believe that there will be market share gains as well, because, in Europe, the energy issue, the availability of raw materials are all playing on the supply chain. So if you have a high quality product, good customer attraction and intimacy, there is potential to grow your business. So I think that on an overall basis, even expecting numbers to be stable in Europe, we should expect some amount of growth. And what we're also doing is, for existing product segments and markets, we're also developing a business through our casting business, which is the ferrous foundry, and trying to grow our engagement and share of wallet of our customers. So that itself is giving a huge opportunity.
Right, Amit. Happy to hear. Good luck and congratulations.
Thank you so much.
It's been a fantastic quarter. We hope you continue to do really, really well. But thanks for joining us.
Thank you. Pleasure.
Well, that was Amit Kalyani breaking it down for us. Bharat Forge has had a good run this quarter. They've seen an improvement operationally on most fronts. They've done a write-down of about 150 crores, which is a provision that they made for an investment in Torque Motors, which, of course, they were not running, but it was largely an investment, and that has gone bad. Well, that was Bharat Forge, and that's the stock at the day's high point, trading with a gain of nearly 3%. Well, let's move on from one company to another. The other one that we're talking to is going to be the management of Concor. Concor right after this break. So stay tuned. We'll come right back. Welcome back. You're watching Earnings Edge, and it's a very, very busy morning with a whole barrage of companies reporting earnings. But the good news is it's Friday and the markets are cheering. Strong global cues and the Nifty is trading well. The breadth is good and earnings are getting rewarded. Concor is the second company that we're talking to this morning. Revenues and profits have grown in single digits, though margins were more or less flat in this quarter. I'm now joined by Sanjay Swaroop, Chief Managing Director of Concor, to add more perspective to these numbers. Hi Sanjay, good morning. Thank you very much for joining us and telling our viewers and your investors about how the quarter's been and what of course lies ahead for your company. Let's start with your FY25 guidance. You've kept that intact. You're expecting, I believe, 15% growth in EXIM volumes, 25% growth in domestic volumes. Walk us through that and what really lies ahead on the volume front for FY25.
Yeah, good morning. Actually, we are very confident that we will achieve the guidance that I gave at the start of the financial year. The EXIM, actually the Q1 of any financial year is normally like this only. Now we are picking up the business. On the EXIM front, there were geopolitical constraints which were impacting the business. More or less, they have stabilized. The movement on the China-America circuit, which was a bit overloaded as far as containerized cargo movement was concerned, is now stabilized. And we are seeing good traction on India-Western world movement and containerized movement. And there is a softening of rates also and good availability of containers as well as vessels. So in the coming weeks, I am very hopeful that the export-import movement from India will pick up very nicely. And apart from that, in domestic, we are having a robust demand. This quarter also we posted 15% growth, and we are very hopeful that we will be able to achieve at least 25 to 30% growth for the remaining months of this financial year. And we have taken several initiatives in EXIM as well as domestic, which are going to pay us rich dividends in the coming months.
Right. So, sir, is it a fair understanding from me that the next couple of quarters, your volume growth will be much higher to average that 10 to 12% for the full financial year?
Yeah, exactly. Our growth will be quite good in the coming months, and which is there is a good demand, and our infrastructure is also ready, and we have been in touch with customers, with industry associations. So we are expecting a very good growth in the coming months.
Right. And what about margins? There was a little bit of a hit on back of the price increase that was undertaken. When can we expect a sharp recovery on margins for the company?
Yeah, like I mentioned that we will have a good growth in Exim, and Exim gives us good margins. Even in this quarter also, there has been a increase of 50 basis points in our market share in Exim. So this will consistently be growing. Customers are happy with our service. Like our company believes in giving excellent service to our customers without sacrificing margins, and customers have respected that and they have stayed with us. So we are going to expect good margins in Exim. Apart from that, we have identified the streams and circuits in domestic, and where we are going to have the loaded movement in both the directions, in ongoing and outgoing and return directions. So that will bring down the running of empty containers, and it will further be affecting positively in my bottom line. So both these streams are going to fetch good margins in the coming months.
So even with higher railway haulage rates, 25% margin should be maintained, right, Mr. Swaroop?
Yeah, actually railway rates were, you know, that busy season surcharge was imposed from 1st of October 2023. It is more or less stabilized, and trade has accepted that increase, and I don't see any reason why we should not get good margins. So I'm very, very optimistic about it. That raise already has been absorbed very well by trade.
You know, sir, you highlighted to me that domestic business should grow with that 25%. Now, where is that going to come on bulk cement I'm talking? What are the other triggers that could help you achieve that very ambitious and healthy number?
See, if you observe our growth for the past 3 years, you will be seeing that every year we are in domestic, we are growing in the range of 25 to 30% back to back. This year also we are expecting a similar growth, because domestic the demand is very, very robust, and that bulk cement in tank containers, as rightly you have pointed out, will be a major trigger for growth. We have had talks with various cement companies, and our order for 500 such containers already we have given, and from third quarter we are expecting that we will start this loading, and trade is even anxiously waiting for arrival of containers, and we have ready-made demand, and we are going to place another tender for procurement of more containers. So this will be a major trigger for growth of domestic business in this financial year.
So I wanted to talk a little bit more about all those new products in FY25, you know, to load bulk cement into tank containers. You're talking about using double stack trains for Nhava Sheva port, and of course establish that dedicated freight corridor as well. You want to walk us through the journey and what you are setting out for the company for the next 2 to 3 years? So I know none of all these will be, they'll be gradual, right? It's not a one-off or a one-quarter event. It's long-term growth for Concor. Strategically, that will change the direction of your company. Tell us, what are your internal objectives and growth plans there?
See, double stack has been a major, you know, driver for growth as far as Exim business of my company is concerned. Last year also we increased by more than 30%. This year in first quarter, double stack growth has been 14% over the similar period of last financial year. We are running timetable trains from Dadri to Mundra port, which is diverting a lot of business from road to rail. Apart from that, Nhava Sheva also we are going to bring on double stack because the last 100 kilometer stretch of DFC is yet to be commissioned. But we have a terminal at Varnama near